everybody. On behalf of my partners here at Picton Mahoney, thanks for having us here. It's a great honor. Julie did a great job putting this gig together. It's kind of like herding cats, I think. Getting these managers to collaborate is fun. Picton Mahoney Asset Management, we've been around for our team has been around for 20 years managing money. We run just over around $7 billion. Our hedge fund business, we've been running for 10 years, both in the equity and fixed income side. Was launched around 9 years ago. I would say that the ultimate objective of our firm, or master function, if you will, is to help clients achieve their goals with greater certainty. So we like to help protect wealth is our master function, and we built the business around that. And we do that by both building solutions for portfolios and managing money, as well as partnering with our clients to help them build overall portfolios, collaborating and debating. I joined Picton Mahoney around 9 years ago to build out the income business. I still remember first talking to Dave Picton and Mike Mahoney was around a table like this. Art Galloway, our CFO, was there as well. I think he fell asleep for most of the meeting though, and we just had one of those Socratic dialogues of building an income business or building any business, and what is income, what are the risks, how do you get the income, how do you manage the risks. Probably one of my greatest experiences, I would say, professionally in my life, as you can tell from my excitement. And yeah, we really built our business around doing that. So it's been 9 years. I would position us as a corporate bond replacement. So we're kind of similar but different than Andrew is doing. So if I can step back at a higher level and look at fixed income from your perspective for a moment, this is a classic way to organize fixed income. This has existed forever. This is how people have allocated in fixed income. My dad showed me this originally, probably 20 plus years ago. And it's divided between core and plus assets. And core assets would be your investment grade, part of the market that people traditionally consider to be lower risk, the safe money where everyone's hiding. And then plus gets into high yield and preferred shares and all that kind of stuff. And one could reasonably argue that that continues into income-oriented equities, which are bond replacements. So when I look at this today, I think allocating in fixed income has probably never been more difficult. In the battle for investment money or high net worth capital or managing money, the battle's going to be won in fixed income, in my opinion, because it's pretty much a disaster when you look at it. It's never been harder, and it's been easy for 30 years, but now we're looking at a transition or normalization of the fixed income market, whatever that means exactly. And we've got to make it to the other side. So we're there to help you get to the other side. And one of the main things I talk to my clients about is, and I think one of the biggest things to focus on right now within fixed income is quality of returns. And what I mean by that, just a simple throwaway conversation is all of the, with the exception of Andrew, of course, all of the historical numbers that you see in fixed income are absolutely useless. So when you look at return volatility, sharp, correlations, etc., we're in a different game. The fixed income market has been truly unchained, which is the title of my new presentation on Celsius Van Halen song. And the Fed's gone, easy money's over, loose money's done. Now we have to figure out how to navigate it. And we haven't seen what's coming since before the financial crisis. So I have to go back to 2006 to see conditions like we see currently. So therefore, fixed income and portfolio construction is extremely important. I think knowing the risks and trying to have a main message paradigm shift in thinking when it comes to fixed income, and try to help our clients and our clients' clients look at forward-looking volatility is not an easy task, but that's what we all need to do currently. So with that rhetoric, let me come back to us. So where we fit in the mix, we're in that middle category there, core plus. So again, we are a corporate bond replacement within portfolios. We're looking to get you a high yield-like return profile with less volatility than the high yield market. To me, in plain terms, that would be a 6 to 8% after fee return through cycle. A true north benchmark, in my mind, for a strategy like what we're doing is a coupon level return from corporate bonds, which has been 6 to 8 through cycle. I'll speak to our Income Opportunities Fund, and I'll speak to the special sits in it after that. But the Income Opportunities Fund was the original strategy that we launched. That's a long-short credit strategy. We've had a just under 8% annualized return after fees, with a 0.4 correlation to the high yield market, negative correlation to governments, and negative correlation to investment grade. So we built something that's different in portfolios. And the idea today is in my mind, for people building fixed income is to just find 3 to 5 strategies that are uncorrelated and that are doing different things within fixed income, and put them together, and then let's navigate that through the other side of this. So we run 3 strategies on the credit side. The main one, as I mentioned, is a long-short credit strategy, and then the second one is our special situations fund, and that's also called not your grandma's income fund. That's looking to get equity-like returns from the credit market. So it's an event-driven credit strategy, which in my mind is the sweet spot of fixed income, and where I spend most of my training ground. So event-driven credit investing is really interesting because of the opaqueness of fixed income, and because it's over the counter. You can really, if you can get an edge, an information advantage, or some kind of edge on the market, you can really take advantage of that. And then the third strategy that we manage is a hedge fund light, fortified income fund, which is a mutual fund type offering. So it's a little bit easier to purchase. And I would say when I look at our process and how we manage money, the way that we construct the portfolio is very simple. We have 2 buckets that we invest in. We focus only on developed markets, and we don't do any emerging markets, just developed markets. We look at single B to triple B. And when I look at the credit market in general, I don't look at the credit market in terms of high yield and investment grade. I think that's a massive oversimplification. I look at it in terms of 3 different markets. There's the equity-like portion of the fixed income market, which is triple C end of the market. If you think of Michael Milken and the days of junk bonds, that would be that part of the market in my mind. And within that category would be the private equity sponsored bonds, such as, if you're familiar with Apollo or KKR, great companies, just don't buy the bonds issued by their portfolio companies, is kind of my rule. So that end of the market is triple C end of the market, that's the riskiest end, so that's equity-like risk, it's not credit. Single B to triple B, that's credit risk, that's where a credit analyst can get in there, rip apart the balance sheet, rip apart financials, and add value to investing. And anything above single A is really just a call in interest rates, it's just duration risk, there's no credit value up there. So that's how I look at the market. So we focus therefore on single B to triple B, developed markets only, and we hedge that back to the Canadian dollar. My view is you want your managers in general to be unconstrained but not unruly. And so you want them to be focused in on a certain segment of the market, and then you can plop that in your overall portfolio. And that's what we're doing. So the way that we invest, coming back to that, is we have always have had this way, 2 buckets that we invest in. And the first bucket is what I call patient capital, which is effectively coupon clipping. You can think of it as probably the most boring part of anyone's portfolio. If I went through the names in that book, I would literally put you to sleep. A classic example I like to give is, Stan doesn't like me giving this one, anyways, Iron Mountain, which is a paper shredding company, and I don't think there's anything more disinteresting than that business model except their bonds. And we've been involved in the name probably since inception, maybe moved out of it here and there, but I think the volatility in the bonds, a couple points, a coupon clipper. That's, you sell those kind of bonds, you never get them back again. So that's the type of stuff, that's your core part of our portfolio. That would be 40%, probably 60% of the portfolio. This is for the income opportunities fund or the mutual fund. And then the other 40% is in event-driven investing. So that's where you get a nice yield, and more importantly, you're looking for some kind of catalyst to make you more money than just the yield. And that's the juice, if you will. So that's being attentive to your investable universe, being responsive when there's news out, and then jumping on that stuff. And I would say the 2 biggest drivers of return today in that category, and this first one's going to sound a little funny, but it's thinking like a CFO. So put yourself in the position of CFO of a company, and just truly, just simply look at how they would think about a particular situation. I'll give you an example in a second. And the other value is covenants. Remember, the covenants are in bond indentures. They're like constraints in the company. It's kind of like hands on someone's neck, if you will, the company's neck. So covenants are very powerful, and you can make a lot of money off of just reading them and understanding how the implications of them. And I would say I haven't seen this kind of power from covenants since probably the early 2000s. And at that time, it all pertained to restructurings in the telecom media tech. sectors. Today, it's like going concern companies that are getting bought by an international company, and you know, all of a sudden, because of these covenants, the international company can't move money in and out of this Canadian entity very easily. Well, guess what? The CFO has to file financials every quarter in Canada, and that's not really a convenient thing for a CFO. So put that kind of logic together. It's very simple, but there's a lot of money to be made in that way of investing, and these are all, you know, really strong companies. So that's the other category, and then you put those two together, so patient capital, event-driven investing, and then overlay that with some hedges to protect the portfolio from interest rate risks, obviously, and credit risks. I think you have a really elegant solution for these current market conditions that are through cycle really evergreen, but certainly for these market conditions. And that's what we're doing. That's it. Well, here's our disclaimer. If our business hasn't gotten any more complicated, I think this says it all. You know, these slides and that disclaimer. Things are getting tough, so you know that's why I believe in collaboration and let's work together and build some better stuff in our portfolios. So, thanks. Any questions? Save for the camera. Thank you.